On Friday, August 28, 2026, Solana validators approved SGP-0002, the first successful vote through the network's new on-chain governance system. The headline numbers look comfortable: 176.29 million SOL for, 66.19 million against, and 20.63 million abstaining. But look closer and the story is chaos. Mert Mumtaz, chief executive of Helios, said the proposal passed by a literal hair after roughly 500 calls in the final hours. Participation reached 60.7% of the 433.49 million SOL snapshot, well above the one-third quorum, yet the result swung on one validator changing sides just before the deadline. That is the real story today. The vote opened on August 23 and reached quorum 27 hours before the end, with 33.84% participation and only 25% in favor at that point. The turning point came today when Kraken's largest validator, holding about 8.9 million SOL, recast its vote from against to for, moving roughly 8.1 million SOL in favor hours before the deadline. Galaxy also shifted from 92% abstaining to 58.36% for. This matters because it shows the decision was not broad-based support. It was a small number of large validators changing the outcome under intense pressure. To understand why this matters, you need to know what doubling the disinflation rate actually does. Solana's current annual inflation is about 3.82%. Under the old schedule, that rate reduced by 15% each year. Under SGP-0002, it now reduces by 30% each year. That compresses the timeline to the 1.5% terminal inflation floor from roughly 2032 to the first half of 2029. Projections suggest around 18.9 million SOL of future emissions are removed over 6 years, worth about $2 billion at current prices. But there is a trade-off. Nominal staking yield is modeled to fall from 5.84% today to 4.34% after 1 year, then 2.25% after 3 years. Lower supply growth helps scarcity, but lower yield could push some validators and investors to look elsewhere. By contrast, the Resource and Inclusion Fee proposal, SGP-0003, failed with only 53.9% support, short of the two-thirds threshold. It tried to replace Solana's flat base fee with a 2,500 Lamport inclusion fee and a separate resource-based charge. The split shows that reducing inflation is easier to agree on than redesigning fee markets. It is also worth remembering the context. Between the 17th and the 23rd of August, Solana had its busiest 7-day period on record, with 1.32 billion non-vote transactions. The network is becoming heavily used, but fee reform remains contentious. So where does this leave Solana today? In the near term, the market will watch whether that 18.9 million SOL reduction is already priced in, and whether falling staking yield pushes capital into liquid staking or decentralized finance. The bigger issue is governance. A handful of large validators flipping at the last minute may have saved the vote, but it also concentrated power. For holders, the maths is simple: slower supply growth is only bullish if demand keeps up. The first on-chain governance test is passed, but the debate about who really controls Solana is just getting started.